He locked $842,000 behind his own signature and put $1.2 million in leveraged equity at risk to avoid a conversation. The transfer took less than 9 minutes. By 3:14 p.m., the capital was gone from the brokerage account. By 3:23 p.m., it sat inside a newly formed LLC owned solely by Daniel Mercer. No co-manager, no trust integration, no spousal authorization, just control. Daniel is 58, net worth approximately $6.3 million, 2.1 million in diversified market portfolios, 1.14 million in commercial real estate equity, $980K in retirement accounts, still 43% concentrated in company stock, $600K in taxable brokerage liquidity, the remainder in operating businesses and private notes. 6 trading days earlier, volatility spiked 11%. He didn't rebalance, he liquidated. Short-term gains were triggered. By week's end, nearly $190,000 in accelerated tax exposure would be locked into this year's return. But the tax wasn't the real risk. The refinance was. One of his commercial properties carried a balloon note, $1.2 million balance, due in 47 days. The loan covenant required proof of accessible reserves, minimum liquidity thresholds, debt service coverage above 1.25. Before the transfer, he qualified easily. After the transfer, $400,000 earmarked for refinance reserves sat inside an LLC the bank could not recognize. His revocable trust didn't own it. His spouse wasn't listed. The operating agreement allowed discretionary movement, but only by him. He called it asset protection. His CPA would later call it structural isolation. At 4:42 p.m., the bank emailed, updated liquidity verification required within 14 calendar days. 14 days. If liquidity could not be verified, the refinance would be repriced or escalated to internal review. Escalation meant scrutiny. Scrutiny meant exposure. Exposure meant leverage risk. Because 2 additional properties were cross-collateralized under personal guarantee. If the refinance collapsed, over $1.2 million in equity could be exposed to covenant breach. One decision. $190,000 in accelerated tax. $1.2 million in leverage risk. 14 days on the clock. His wife didn't know he moved the capital. His advisor didn't authorize the liquidation. And the estate attorney had never seen the LLC filing. Daniel believed he was protecting the perimeter. But the question forming quietly beneath the surface was this: is he building governance, or is he tightening control because no one ever governed him? The clock just started. Stop. The refinance officer doesn't care about strategy. She cares about accessible liquidity. If Daniel cannot verify at least $350,000 in unencumbered reserves within 14 days, the bank will reprice the loan, adding 1.75% to the fixed rate. On a $1.2 million balance, that's roughly $21,000 more per year. Over 10 years, that's more than $200,000 in added cost. Because he wanted control. His CPA, Martin, calls the next morning. You converted liquid capital into structurally isolated capital, Martin says evenly. The bank sees opacity. It's safer, Daniel replies. For who? Martin asks. Your trust doesn't own it. If you're incapacitated, Laura doesn't automatically control it. Silence. Daniel hadn't considered incapacity risk. He had considered volatility. He had considered market drawdown. He had not considered succession friction. The refinance deadline now reads 12 days. To restore liquidity optics, Daniel considers pulling $200,000 from his 401k. He's 58. Early withdrawal means 10% penalty immediately. Ordinary income taxation at his 35% marginal bracket. Increased adjusted gross income. Potential Medicare, IRMA bracket impact in retirement modeling. accessing $200,000 could cost nearly $90,000 in penalties and taxes. Short-term relief, long-term structural damage. He shifts tactics. Instead, he instructs his broker to liquidate $300,000 of municipal bond funds in his taxable account. Those bonds were part of his income smoothing strategy for retirement volatility. Short-term capital gains apply. The projected tax exposure now approaches $190,000 year-to-date. His after-tax net worth effectively compresses from $6.3 million to approximately $6.12 million. Control is becoming measurable. That evening, Laura sees the transaction alert. Why is $300,000 missing from the brokerage account? I restructured it. That's not what I asked. He exhales. The bank needed stronger optics. And you didn't think I needed transparency? Confrontation 1. Calm. Direct. She doesn't raise her voice. She asks one question. Is this governance? Or is this fear? The refinance deadline drops to 10 days. At 9:12 a.m. the following morning, the bank sends another notice. If liquidity cannot be verified within 72 hours, the file will convert to floating rate status pending review. Pending review. That phrase tightens his chest. Internal Risk Committee, reclassification, future lender perception, reputation risk, not just rate risk. Daniel thought he was defending capital. He may have destabilized credibility, and the LLC still sits outside the trust. Stop. 9 days before the refinance deadline, Daniel schedules an emergency meeting with his estate attorney, Rebecca Hale. She reads the LLC formation documents in silence, then she closes the folder. You formed this without assigning membership units to your revocable trust, she says. If you die, this asset sits outside your estate plan. It's temporary, Daniel replies. There is no temporary in governance. She outlines the exposure with precision. Sole member, Daniel Mercer. No successor manager designated. No operating restriction on discretionary transfers. No alignment with your wealth transfer hierarchy. No coordination with existing asset protection layers. If you become incapacitated, she continues, Laura would need court appointment to control this entity. Probate exposure becomes real. Estimated legal cost, $60,000 to $85,000. Potential delay, 6 to 12 months. Possible beneficiary dispute if interpretation conflicts. Daniel shifts in his chair. He built the LLC to eliminate uncertainty. He introduced new uncertainty. Microclimax. Rebecca slides a notepad toward him. You have 2 options. Option 1, contribute the LLC membership units into your trust immediately. We may trigger reporting requirements depending on valuation treatment. Option 2, dissolve the LLC, move capital back into taxable brokerage, restore liquidity optics before the bank escalates. What's the cost? Daniel asks. Legal unwind, accounting reconciliation, filing fees, approximately $20,000. On top of the already projected $190,000 tax exposure. He calculates silently. But Rebecca isn't finished. There's another risk you're ignoring. She pulls up his retirement allocation summary. You're still 43% concentrated in company stock inside your 401k. That's identity risk disguised as loyalty. He stiffens. That stock built this portfolio. And concentration has broken more retirements than volatility. Second microclimax. He opens his retirement dashboard. 43% in a single employer position. Market beta elevated. Downside concentration risk unhedged. He executes the trade, reduces company stock to 25%, reallocates into diversified index exposure and short-duration treasuries. Inside a retirement account, no immediate tax event. Retirement depletion probability drops by 6% in updated modeling. For the first time in this crisis, a decision is rule-based, not reactive. Rebecca watches quietly. That's governance, she says, not liquidation. But the refinance deadline still shows 7 days remaining, and the bank has not confirmed final approval. Daniel built armor to feel safe. Now he has to decide whether that armor isolates him or integrates him. Stop. 5 days before the refinance deadline, the bank responds. Conditional approval. But only if Daniel restores $300,000 in verifiable personal liquidity outside the LLC within 72 hours. Otherwise, the loan converts to floating rate status pending internal review. Pending internal review. That phrase lands harder than the interest rate. If the file escalates to the bank's risk committee, his liquidity profile gets flagged, and flagged borrowers don't just pay more, they get watched. Stephen, his financial advisor, doesn't soften it. If they reclassify you as covenant unstable, every future lender sees it. This becomes reputational. Not just rate risk, reputation risk. Daniel calculates quickly. If the loan converts, 2.1% rate increase, approximately $25,000 per year, $250,000 over the term. If the refinance collapses entirely, 2 additional properties tied by cross-collateralization clauses could be exposed. Roughly $1.2 million in equity enters default sensitivity. Stephen leans forward. You destabilize liquidity optics to avoid feeling vulnerable. Daniel's jaw tightens. I stabilize the perimeter. No, Stephen replies. You centralized authority. Confrontation 2. Direct, surgical. That evening, Laura sits across from him. No raised voices, just clarity. You didn't ask me, she says quietly. I was handling it. That's not partnership. He stares at the refinance spreadsheet. I didn't want the bank dictating terms. She nods once. And I didn't want to wake up inside decisions I never agreed to. Silence. Then he says it, not defensively, not dramatically, quietly. I didn't learn governance. A pause. I learned control. The room changes, because control was never about liquidity. It was about never depending on anyone. Microclimax. Rebecca calls with final clarification. If you leave the LLC outside the trust and something happens to you before we correct structure, Laura could face probate proceedings costing $60,000 to $85,000. Possibly more if beneficiaries contest interpretation. That is quantified near crisis. $85,000 in avoidable legal exposure. $250,000 in potential interest escalation. $1.2 million in cross-default sensitivity, and 72 hours on the clock. Daniel opens his laptop, drafts dissolution documents, calls Stephen. Move $300,000 back to the brokerage immediately. Understood, Stephen replies. The unwind begins. The tax consequence becomes permanent. Projected year-end liability stabilizes near $191,000. Combined structural friction now exceeds $200,000. Net worth recalibrates to approximately $6.09 million. Control has become expensive. But the refinance decision is still pending, and now the bank is watching. Stop. 72 hours later, the bank confirms final approval. Fixed rate preserved, no repricing, no escalation to committee review. The refinance closes, liquidity threshold satisfied, but the cost is now permanent. Projected year-end tax liability, $191,000. Legal restructuring and unwind fees, $22,000. Estimated opportunity cost from forced liquidation if markets rebound, approximately $30,000. Total structural impact, just under $250,000, $250,000, not from market collapse, from unilateral decision-making. But something else shifted. And this time, it wasn't capital. Rebecca restructures the LLC properly. Ownership assigned to the revocable trust. Successor manager documented. Liquidity thresholds written into operating terms. Minimum $400,000 reserve requirement formalized across all entities. Stephen updates the portfolio framework. 12 months operating liquidity in high-yield reserves. 18 months debt service segregated. 401k, concentration permanently capped at 25%. Tax loss harvesting strategy initiated to offset $38,000 of realized gains. No reaction. Rule-based governance. Laura attends the final meeting, not as observer, as co-decision authority. Rebecca looks at Daniel. Governance is not about preventing loss, she says. It's about preventing unilateral damage. Daniel nods. His net worth is lower. But his structure is stronger. Refinance stabilized, probate exposure eliminated, concentration risk reduced, liquidity alignment restored, reputation preserved. Later that night, he and Laura sit quietly. No spreadsheets, no alerts. I thought if I held everything tightly enough, he says, nothing could destabilize us. Laura answers without hesitation. Things don't destabilize because you hold them. They destabilize when no one else is allowed to hold them with you. He doesn't respond immediately. He opens the updated balance sheet one final time. Smaller, more resilient. For the first time, authority is distributed, not centralized. Control isolates. Governance assigns responsibility. Control reacts to fear. Governance designs for succession. Control protects ego. Governance protects structure. If this uncovered something you've been carrying quietly, tell me what you realized. Control feels strong in isolation. Governance is what survives you.